Pete Rose, Longwood Currency Trading. Good morning. It's a chilly mid-September day in 2021. In fact, it was so chilly that the heat went on, and we usually set those, down really low. But when the temperature drops below 50 at night, I think a couple of the thermostats caught that, and boom, they went off. So it's something else. My wife went out to walk the dog this morning and took a picture of the valley that's below us. We're about 960 feet above sea level on this little mountain. And as you go over the top of the ridge and down the other side, you can see the valley below. And it's totally fogged in down there, but it's bright and sunny up here. So I'll show you that picture if I remember. If I don't, you can email me and ask you to send the picture. And so what's that got to do with the basics of Forex trade entry decision process? Well, not a lot, but let's form a correlation. Look, you are presented with certain facts. You got fog over the valley, the thermostats go on, and you make the assumption that the temperature must be down. And so you then make decisions based on that information that you have. And we're basically doing the same thing in our trade entry process, right? Trade entry is really complicated because if you get it wrong, you get stopped out. And if you get stopped out a whole lot of times, you lose all your money, right? So it's really the most critical point. It's really not the most critical point. There's one point that's more important than that, but I'm not going to get into that right now. We're talking about the importance of that, understanding that trade entry decision process. My whole process of teaching and education is to make things simple. And so we're going to make this ridiculously simple and go through it. Are these the only alternatives? Is this all you have to think about? No, it's certainly not. What they form is nodes of information that provide the opportunity to ask questions, and the solutions to those questions are found in the rules that you developed as part of your trading plan, the tactical execution of a strategic structure or form that you have seen in front of you. The best advice that I can give you, first of all, you have to know what questions to ask. Second of all, and more important than that, because the assumption is that you do, is that if you ask a question based on the situation that you're seeing and you don't have a rule for it, then you either negate that totally, or you say, I've seen this before, maybe in more subtle forms, and I just ignored it as blending in as part of something else that I had a rule for. But this is different. And so maybe I need to rethink my whole opening theoretical structure that surrounds this particular situation to see if it is a unique situation or whether it's a corollary of an existing rule that I already have. In which case, do I create a corollary rule, or do I redo the entire rule set for this opening theory under these strategic conditions? Does that make any sense? Well, if you have any trading background, it should. What that also says, and that's the reason I asked you that question, was because that was a fairly complex discussion of analysis of an opening situation. And so how do we break that? How do we break out of that? How do we simplify that? Well, you look at a picture of a house and it's really beautiful and it's really complicated to build the house, but you know what? It's going to be on a foundation. And that's a very simple thing. I mean, obviously you have to know what the load-bearing capability of that foundation is in order to support the structure you're going to build on top of it. But given that information, you can build the foundation, and that's a pretty simple thing to do. And then you don't have to worry about building the house and bracing it up because you've got a good foundation. And so I'm going to throw up a picture on the screen here as a simplified view of price action or the market at a certain point. So there it is, where you see the black dot, or the black dot. You're watching it in color, hopefully. The price action is in black, and the current price position is in black. It's a big black dot. Okay, so that's a very simple representation of price action. There you have it, and so you open your trading platform up, and that's what you see. Great. Okay, let's go to the next slide. You can see that I've drawn 3 green lines. And that's the potential for what that price could do. The price could go up from there, it could go sideways, or it could go down. Or it could do some combination of those 3. But at the next particular tick of the clock, it could go up, it could go sideways, or it could go down. And so you look at the next slide, and there's the distribution of probabilities of what could happen on the next tick. You got a 33% chance that it's going to go up. You got a 33% chance that it's going to float sideways. You got a 33% chance that it's going to go down. So basically, you know what, you could really eliminate that first 33, because if it goes sideways, it isn't going to go sideways forever, and so it's either going to go up or it's going to go down, which means that the up and the down are basically 50-50 jump ball. And that's called random price movement. Yeah? All right. So what do we think about that analysis so far? Do we agree with the premise as stated that there are those 3 potential things that could happen at that particular time? Each one of them has a 33% chance of occurring, and yet at the same time, we might be able to negate that middle one, the flat line condition, because at some point the price is either going to go up or it's going to go down. Right? I mean, price isn't going to remain totally stagnant. It is going to move. Somebody's going to have to buy, somebody's going to have to sell. You're going to have a move. So at some point along that x-axis, that horizontal x-axis, that price is going to tick up or down. So you get a 50-50 jump ball. And when you have 50-50 jump ball, that equates to a random process. If you don't know what it's going to do, then the action is random. And from a mathematical standpoint, price action is random. If you study physics and mathematics, there's a thing called Brownian motion, and it's a study of little particles in a fluid. And it's like a bunch of leaves that are floating in a river. And that river is moving downstream, right? And you have all these leaves in there. Well, if you pick out one leaf, that leaf could be caught in an eddy and be going against the current. It could go sideways. It could get hung up on a rock. It could be going with the current. So you can't really tell what that one leaf is going to do. That's totally a random situation, and all the leaves in there, if taken individually, are totally random. And yet through the mathematics of Brownian motion, you could say that you have a very high probabilistic chance that because you know the direction of the major flow of the river, that you also know what the statistical likelihood of any individual leaf in that river, the direction that it's going to move in. And not only that, but also you can pick up not only the direction, but the magnitude of that move. So those are things that are probabilistically calculable, okay? So let me throw up one more final slide. And as you can see, in the blue line, the price is the moving average. Let's call it 55 or 100, whatever you want to call it. But it's obviously showing that overall, the price action is moving up. And so now you have a river that's moving in a certain direction, and so you can therefore say with a higher statistical probability that that individual price, that next tick in the price, that's going to move up. So now you really don't have a 33, 33, 33 distribution. You've got just the single 33% distribution, and you can negate the other 67%. Well, what that means, if I bring the slide back to me, what that means is that you have a 67% probability, likelihood, that the next price movement will not only be up, but it will continue to go up in the long run. That's a good thing to know, to be able to stay. Now, we also have to indicate that there is a probability, well, if there's of it going down. There is a probability of it going sideways. Well, what are those probabilities? If I have a 67% probability that it's going to go up, then I have a 33% probability that it's either going to go sideways or going to go down. Since I'm not worried about the sideways part, I have a 33% chance that it's going to move against me. So it's 67% in my favor and it's 33% against me. I take those odds any day of the week. And that is basic Forex trade entry decision process in its most rudimentary form. I have spoken for hours on each aspect of that process. But the thing that I want to get across in this video is that you can lead yourself to very complex issues that have simple solutions if you understand the simplicity of where all the information is coming from. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.